Yep. Good morning. Welcome to AmericaFirst Wealth Management Investment Outlook for September 30th, 2024. My name is Dan Liu. I'm Chief Investment Officer and Portfolio Manager. And joining me today is Michael Cheah, our Head of Fixed Income and Portfolio Manager. Next slide, Mike. There's our standard disclaimer. We're not offering any investment advice here. We're just offering our opinions as of September 30th and are subject to change without notice depending on changes in information in the marketplace. Next slide, please. So what we like to do is begin with our investment outlooks and then provide additional data. So I will go first. So my market outlook is, with only one day left in September, it's looking like a positive month as we predicted earlier this month. For October, we're expecting to see higher volatility with corporate earnings reports, possible softness in labor. There's a potential dock worker strike that is concerning, that could impact flow of goods, and also continued election fear-mongering. However, we've seen central bank panicking, certainly with the Fed 50 basis point rate cut earlier this month, and also of the central banks following suit and relaxing, especially with China that we saw last week. And if there's any pullbacks, the central bank panicking suggests that these will be buying opportunities. And November could bring a post-election relief rally as all the fear-mongering ends. The key macro data points to watch out for this week are Monday around 2 o'clock, it's Fed Chairman Powell's speech. Tuesday, we've got ISM manufacturing PMI and JOLTS job openings. Thursday, 10 a.m., ISM services PMI. And Friday, 8:30, non-farm payrolls and unemployment rate. So those will be key things we keep our eyes on. Turning to the weekly market stats, and I'm going to jump to the month-to-date column, and so you can see all the equity indices and fixed income are positive month-to-date, and with one trading day left, it's likely that will end in the black for the entire month of September. For the week, good returns across the board, with the exception of small caps, which saw some softness. Quarter to date and year to date, all the numbers are in the black, and it's looking like we're climbing the wall of concern with a pretty bullish market and pretty much green across the board. Next slide, Mike. This is a chart of the S&P 500 for the last 1 year period, still trending higher. We are looking at all-time highs. The dashed line is a 10-day moving average, which we're kind of bumping at that level here. Whether or not it continues to bump along that level or soften it a little bit, I think will be determined by other factors. The RSI is getting towards a overbought level, so we got to watch that. Looks like it could still trend a little bit higher or go flat, given information and news going forward. Next slide, Mike. 10-year Treasury yield rate. We saw a pickup in the yield after the Fed rate cut. Softened a little bit towards the end of the week, but the trend is now turning up. 10-day moving averages has turned up as well. And I apologize. The 375 is the Friday's 10-year rate, and 373 is the week before. So we had a 2 basis point increase on the week. And for the year, we're down 13 basis points since 388 down to 375. Next slide, Mike. Yield curve. The bottom line represents the past 2 weeks, the 27th and the 20th. Not much movement there, kind of almost mirroring. And you can see the year December is a yellow, year-end 2023, and the June, a big drop in the yield curve since the end of the second quarter. Yield curve still remains inverted, but we are positively sloped from the 3-year out to the 30-year. Next slide, Mike. The 10 minus 2-year Treasury spread continues to steepen, as we see here, as the curve attempts to normalize. So this certainly has implications in financial firms, as they tend to borrow short and lend longer. So the steepening should improve their profitability. Next slide, Mike. Turning it over to you, Mike.
Okay, thanks, Dan. So I'm seeing more signals, making me ask the question: why the Fed cut rates so soon when the economy is still strong and inflation has stopped declining? And we are watching very closely, and I can see how this week the TLT has weakened, dollar has weakened, and gold rallied. So basically, these three asset class is telling us that they may think that inflation is coming back. And the surprise is China finally turned to fiscal policy to help the economy to recover. So this has been long in waiting, and now they finally make that move. The economy, as you can see here, we have the manufacturing sector down, but service sector and overall is stabilizing, right? So at a high level. So we are not seeing signs of weakness as before when the Fed had cut rate. And when we look at the PMI price increase, again, we are seeing stabilizing to some slight increase. And this is interesting because if you look at the red color histogram, this is a profit, okay? So companies are still showing profit, and the blue line is a real unit labor cost. This is unit labor cost after inflation. So what we are seeing is that real unit labor cost is down, and companies has profit. So this positive margin should support U.S. job, right? Companies are not just going to fire workers for the fun of it. It's a very serious decision. And right now, what this chart is telling me is that they have money, and the workers are working hard enough to justify whatever pay they're getting. So clearly there is no reason whatsoever for the economy to weaken at this stage compared to previous time where there was no profit, unit labor costs went up, and you can see here and here and here as well. Moving on, inflation, what we are seeing is that the recent softening has been mostly a function of supply. So you look at the blue line, supply-driven contribution to month-on-month core PCE has declined, but demand is still very strong, right? So when the supply side stabilize and turn positive, then we are going to see an upturn in inflation. So monetary policy, another interesting perspective, basically again saying that the Fed is cutting way too early compared to previous episode. So here you see the unemployment rate today is far below the 20th and 80th percentile, and very, very strange, very, very strange why they would cut rates so early. And we know that the Fed funds rate is one of the many variables that affect the financial condition, the overall financial condition. So this is the Chicago Fed National Financial Condition Index. basically taking into account of the bank lending standard, leverage in the market, corporate bond spread. So basically, what they're telling us is that the condition is very loose, right, compared to the tight condition during COVID and the tight condition here during the great financial crisis and the dot-com, right? So we see how previously tight condition, Fed cut rate, right? Almost tight condition, Fed cut rate, tight condition, Fed cut rate, and oops, here we have a very, very loose condition, and basically the Fed is adding more kerosene or petrol to the fire, right? So that I think is going to make the economy grow stronger, and a matter of time when we're going to see inflation turning up again. Bond market, this is the Fed cut, and the TLT has been declining since then. And one of the major reasons possibly is because China continue to show a pattern where they are reducing the holding of treasuries, either outright selling or allowing their holdings to mature and use the proceeds to buy gold. Dollar, Fed cut rate on September 18, and the dollar had weakened. And it's interesting now how the dollar seems to be bouncing around very close to the 100 level. And let's see if we will break below this magical 100 level. And if you look at the historical episode, previously the dollar has declined going into the Fed cut and continued to decline for a while. So let's see if this will continue. Gold, Fed cut rate September 18, and gold has been going up ever since. And this is China, and we are seeing the Chinese currency strengthening against the dollar. And the Chinese stock market, FXI, has rebounded sharply, pretty much erasing the whole year's loss. Well, the important question here is that if the Chinese stock market recovers, that could lead to a recovery in the Chinese economy. And if so, we know that China import a lot of commodities. Right. The question then is, is this Fed cut so badly timed? It comes just when China is recovering from its economy, and that will lead to a strong demand for commodities and lead on to a U-turn in inflation. And this is a chart to show how the CSI 300 has broken above the 200-day moving average. So whatever it takes, part one, and the central bank have come, the Chinese central bank has come out to support, and one of the initiatives is to help firms buy back their own shares by refinancing bank loan, assist securities company, insurers, and other institutional investors in raising funds by strengthening their balance sheet. And China's bond issuance issue another 2 trillion yuan of bonds. This is about 1.5% of China's GDP. Previously, they have issued 2 trillion. Now this is not 2 trillion. 4 trillion equals to 3% of China's GDP. Allocation of funds. Half of this is to mitigate the risk of local government going bankrupt. And half of this is to encourage spending by household and firms. Spending initiative, invest in cash for clunker scheme to promote trading in old equipment, cars, appliances, newer and greener options. Finance a monthly handout of 800 yuan per child like to support expanding families. So, and this is after several attempts to support the stock market and economy. This is the first time I noticed that Xi Jinping himself came out to articulate the plan. So his personal stake is highly tied in to make sure that this time the economy do recover. So he has guaranteed safeguard the bottom line of people's livelihood, focus on employment for key groups such as fresh college graduates, migrant workers, people who have escaped poverty and zero employment families, strengthen support for groups with employment difficulties such as the elderly and disabled, strengthen assistance to low-income people, and ensure the supply and price stability of important materials such as food and water, electricity, and heat, right? So looking forward to the next few steps, as the Chinese economy recovers, what will happen to the commodities market? Will a stronger Chinese currency weaken the dollar further? How will the Fed react to both a stronger commodities market and a weaker dollar? Right. So that's what I have for you guys this week. Back to you, Dan.
Yeah, interesting dynamics, Mike, and certainly the it's almost unprecedented, the fiscal policy stimulus that China is enacting here. And I know you shared some charts with me early in the week with the Chinese stock market being heavily shorted. Um, and I read about a lot of quant hedge funds who are heavily short China couldn't cover. So it looks like the rally in Chinese stocks would probably continue. Certainly the actions by the Fed and then following up with China's fiscal stimulus seems to be inflationary, certainly at some point. We're seeing a huge jump in industrial metals and precious metals, but we haven't seen confirmation by energy stocks, which I'll touch upon later.
Yeah.
But turning to the Magnificent Seven stocks, it was kind of a mixed bag for the week. Tesla had a huge rebound, leading the pack for the week. Amazon, Microsoft, and Apple were down, and the other three names were up. Tesla, as we know, is the laggard year to date, so it looks like it's playing some catch up here, and certainly Magnificent Seven names are continue to be a force to reckon with among large cap investors for the year, as well as for the prior year. Next slide, Mike. Turning to the sector performance, materials were the big leader. As I mentioned before, a big run up in industrial metals. You'll see it on the futures chart later. We had a nice pickup with retail sales were promising. Consumer discretionary was good for the week. Industrials were third best performer. And on the laggards, healthcare and energy and financials were the three laggards. Whatever. Otherwise, it did suggest that the sector performance is largely following the interest rate stimulus, as one should certainly expect when rates are cut. Historically, materials and discretionary industrial stocks do tend to do well. So it's almost textbook what the sector performance is showing here. Next slide, Mike. Turning to the factor performance, buybacks and private equity stocks were among the leaders. And pretty much across the board in style, everything was up. Value had a resurgence along with high dividend stocks, and momentum being third under the style factors. Next slide, Mike. Commodities, you see at the bottom, huge jump up in aluminum, copper, and steel. Precious metals were the laggards on the metals, but also up positive on the week. Big bounce in natural gas, which tends to be the most volatile energy commodity, up 24% on the week. And doing pretty strong month to date as well. And pretty much across the board in the other energy commodities are down month to date. Last week we did mention that energy stocks look cheap, but we do need to wait for crude oil prices to rally before we see some benefit translating to those stocks. Next slide, Mike. Turning to agricultural commodities, pretty much inflationary in terms of the agricultural commodities, with the exception of cotton and rice, which you can see pretty strong jumps. Cocoa, coffee, soybeans, lumber, corn, all up pretty strong on the week. Commodities are sensing inflationary pressure, demand from pretty much from China as the stimulus causes them to buy more. Next slide, Mike. Turning to the economic calendar, as I mentioned, Monday, later today, around 2 o'clock, Powell's speech will be important to listen to see if he gives some insight as additional insight as to why they cut a very large 50 basis points. And then following up on Tuesday, looking at manufacturing PMI, and then first of the jobs numbers, the job openings will be important. I know talking to a number of people during the week last week, there are very few job openings now, and it seems like among people I've spoken to, if you have a job, you're better off trying to stick with it because there's very little job openings out there. So looking for the job openings data to see if that confirms the anecdotal evidence I've collected during the week. Next slide, Mike. Wednesday, this is pretty standard what we see. We get mortgage rates, some energy data, and Fed governor speeches. The energy draw inventory numbers will be important. We're getting to the point where as the seasons change, it starts to get colder. People start predicting cooling days and demand for heating oil. And also the refineries are switching over from gasoline to heating oil production. It's kind of a stump period. The data is kind of tricky, but eventually we'll see what the demand for oil is, and hopefully we'll see a recovery in prices. Next slide, Mike. On Thursday, as I mentioned, the ISM Services PMI, 10 o'clock. That'll be a key number. We also have initial jobless claims in the morning, 8:30. Calendar job cuts and continuing jobless claims. So jobs data will definitely be important on Thursday as well as in addition to the services PMI. And turning to Friday, to close the week on a macro, we have, next slide, non-farm payrolls and unemployment rate. So a lot of big macro data during the week. Should be some macro movement on that. So we got to pay attention to that. Next slide, Mike. Turning to the S&P 500 earnings. Not much for the week. I do want to highlight that we have 3 food stocks, McCormick, Lamb Weston, and Conagra, and also alcoholic beverages company, Constellation Brands. Those would be pretty interesting to look at, especially to see what the impact of Ozempic and the GLP-1 weight loss drugs has been. We've seen much decrease in demand for food and restaurants, and we're going to see if these companies report pretty much similar information, weakening demand due to the GLP-1 weight loss drugs impacting their business. Interesting to see. Carnival reports pre-market on Monday, and Carnival is one of the big bellwether cruise lines, and we'll see if the consumer has recovered strong enough to continue cruising. We're looking at 31 cents increase, consensus being 117. Nike is an important one to watch. Huge down earnings year over year, down 42 cents year over year, 52 cents. We do have a new CEO, and hopefully stock is nearing a bottom, and the CEO is going to announce hopefully new initiatives to turn the brand around and recover. Obviously, Nike's a very strong company. They've got a lot of depth and breadth and resources to turn things around. And the stock has moved up in anticipation of that, but the earnings on Tuesday after market is where the rubber meets the road, and we'll see if consensus estimates are met and what guidance looks like given the expected new initiatives that will be taking place. And that's pretty much it. Paychex is also reporting flat earnings, $1.14 versus a year ago, same number. And that's it on earnings. And moving to the last slide, Mike. And as always, if any of our viewers and listeners would like to learn more about our products and services or to schedule a one-on-one call with us, please contact Cleveland Ashley. His information is listed here. And with that, it'll be a very interesting week. Lots of volatility expected for this week and also for the month. And as earnings start coming in later this month, it'll be a shaky month in my opinion. But as I said earlier, there'll be some great opportunities, and for investors that can look through the trees and see the entire forest. I think they'll see that coming out of it after the elections. November should be a pretty good month, and we're going to have some pretty good opportunities amidst the volatility and all the noise. So stay tuned, and if anyone would like to follow up with anything, please feel free to reach out. And anything you want to add, Mike, before we close?
As usual, we are here to help. So let us know how we can help.
Okay, thank you. Have a good
Thank you.
week, everyone. See you next week.
Yeah.
Take care.
Bye-bye.